Welcome back to the Financial Nexus. We're examining a development that represents more than just another fiscal milestone. What we're witnessing is the systematic breakdown of assumptions that have guided American fiscal policy for decades as the United States approaches a debt-to-GDP threshold not seen since the nation was demobilizing from the largest military conflict in human history. The Congressional Budget Office's latest projections reveal that federal debt held by the public will reach 108% of GDP by 2030, officially surpassing the post-World War II record of 106% set in 1946. But this comparison, while historically significant, obscures the fundamental differences between wartime borrowing for national survival and peacetime borrowing that has become structurally embedded in the American fiscal system. Unlike 1946, when debt represented temporary wartime expenditure that could be rapidly reduced through demobilization and economic growth, today's debt reflects permanent structural imbalances that show no signs of self-correction. The United States is not emerging from an existential conflict that can be concluded with victory parades and military downsizing. Instead, the nation faces demographic transitions and spending commitments that guarantee debt growth regardless of economic performance or political leadership. Current national debt stands at $39 trillion as of March 2026, with projections indicating it will exceed $63 trillion by 2036. These numbers represent more than accounting abstractions. They reflect a fundamental shift in the relationship between government finance and economic reality that creates systemic vulnerabilities extending far beyond fiscal policy into questions of monetary system stability and international economic leadership. The mathematical progression of this debt accumulation reveals patterns that defy traditional economic assumptions about sustainable government finance. Interest payments alone consumed over $1 trillion in fiscal year 2026, representing 15% of all federal spending. The Congressional Budget Office projects these costs will exceed $2 trillion annually by 2036, consuming nearly 19% of federal expenditures during a period when infrastructure needs, climate adaptation, and technological competition will demand massive public investment. What makes this trajectory particularly concerning is the demographic driver that ensures its continuation regardless of policy interventions. America's aging population creates spending pressures that operate independently of economic cycles or political preferences. Social Security and Medicare expenditures are projected to rise from 9.1% of GDP currently to 11.5% by 2035. This increase reflects mathematical certainties about population aging, not discretionary policy choices that can be easily reversed. The comparison to post-World War II debt reduction reveals why current circumstances represent unprecedented challenges rather than historical repetition. The debt-to-GDP ratio fell from 106% in 1946 to 23% in 1974 through a combination of primary budget surpluses, surprise inflation, and financial repression that cannot be replicated under current economic and political conditions. Post-war debt reduction benefited from unique circumstances that no longer exist. The Federal Reserve maintained artificially low interest rates through financial repression, essentially forcing savers to subsidize government borrowing at below-market rates. Surprise inflation eroded the real value of outstanding debt, while economic growth accelerated through demographic expansion and productivity gains that reflected recovery from wartime disruption rather than sustainable long-term trends. Current economic conditions preclude these historical debt reduction mechanisms. The Federal Reserve operates under inflation-targeting mandates that prevent deliberate debt erosion through surprise inflation. Financial markets have evolved beyond the regulatory constraints that once enabled financial repression. Most critically, demographic trends now work against, rather than for, fiscal sustainability, as workforce growth slows while dependency ratios increase. The structural nature of current spending commitments creates mathematical impossibilities that distinguish today's fiscal challenges from historical precedents. Medicare and Social Security represent legal obligations to future beneficiaries that cannot be reduced through administrative efficiency or economic growth. Healthcare cost inflation consistently exceeds general price inflation, ensuring that medical spending will consume increasing shares of national resources regardless of technological advancement or policy reforms. These demographic and healthcare cost pressures intersect with debt service costs to create feedback loops that accelerate fiscal deterioration. Higher debt levels require larger interest payments, which necessitate additional borrowing, which increases debt levels, which requires still larger interest payments. The Congressional Budget Office estimates that cumulative net interest payments over the next 30 years will total $52.8 trillion, equivalent to 181% of current GDP. The international implications of American fiscal deterioration extend beyond domestic economic policy into questions of global monetary system stability. The United States benefits from what economists call exorbitant privilege through the dollar's role as the dominant international reserve currency. This status allows America to borrow in its own currency at rates that would be impossible for other nations with similar debt burdens. However, this privilege depends on international confidence in American fiscal sustainability and economic leadership. Countries like Japan maintain higher debt-to-GDP ratios, but they finance their borrowing primarily through domestic savings rather than international markets. The United States depends heavily on foreign creditors, who hold approximately $7.7 trillion in Treasury securities and who evaluate American creditworthiness based on long-term fiscal trajectories rather than short-term political promises. China's gradual reduction of Treasury holdings since 2018 signals shifting international perceptions of American fiscal management. While China reduced its holdings for strategic rather than financial reasons, the precedent demonstrates how quickly international support for American borrowing could erode if creditors lose confidence in long-term sustainability. Japan has become the largest foreign creditor, but even Japanese institutions face limits on their capacity to absorb unlimited American debt issuance. The political economy of debt reduction creates additional obstacles that did not exist during the post-war period. Current spending commitments reflect decades of political promises to various constituencies who view benefit reductions as breaches of social contracts rather than necessary fiscal adjustments. The political coalitions that support major entitlement programs represent mathematical majorities of voters who can prevent reform through electoral processes. Revenue increases face similar political constraints, as tax rates have become symbols of ideological identity rather than technical fiscal tools. The Tax Policy Center estimates that the 2025 tax legislation will add $4.1 trillion to deficits over the next decade, but this represents only one factor among many that drive structural imbalances. Even complete reversal of recent tax changes would not eliminate deficit growth, driven by demographic transitions and healthcare cost inflation. The intersection of debt service costs with infrastructure needs creates strategic vulnerabilities that extend beyond fiscal policy into national security concerns. America's global technological leadership depends on public investments in research, education, and infrastructure that become increasingly difficult to finance as debt service consumes larger shares of federal resources. Countries with lower debt burdens can invest more aggressively in technological development and infrastructure modernization. China's infrastructure investments and technological development programs operate without debt service constraints comparable to those facing American policymakers. While Chinese debt levels have increased, their fiscal system allows strategic investments that would be politically impossible in the United States given current budget pressures. American technological advantages that emerged from decades of public investment in research and development could erode if debt service costs prevent continued investment in innovation. The timeline for fiscal crisis remains uncertain, but the mathematical progression toward unsustainability is clear and accelerating. Credit rating agencies have already downgraded American debt from AAA to AA+, following previous debt ceiling crises, indicating that international confidence in American fiscal management has been shaken despite continued market demand for Treasury securities. The precise trigger for fiscal crisis cannot be predicted, but the vulnerability increases as debt levels rise. Economic research suggests that fiscal crises typically emerge when investors lose confidence in government ability to service debt, without creating inflationary pressures or implementing growth-destroying tax increases. These confidence shifts can occur rapidly and without clear warning signs that allow policymakers to implement preventive measures. The Rand Corporation's analysis indicates that reducing debt-to-GDP ratios to post-war lows would require sustained economic growth of 3.2% annually over 30 years, approximately double current projections. Such growth appears mathematically impossible given demographic trends and productivity constraints that reflect fundamental economic realities rather than policy failures. Alternative debt reduction strategies require primary budget surpluses that would necessitate spending cuts or tax increases of unprecedented magnitude. The Committee for a Responsible Federal Budget estimates that eliminating structural deficits would require spending reductions or tax increases equivalent to several percentage points of GDP sustained over decades. Such fiscal adjustments would likely trigger recessions that reduce growth and tax revenues, potentially making debt problems worse rather than better. The international precedents for managing similar debt burdens offer limited guidance for American policymakers. European countries with comparable debt levels operate within monetary unions that constrain their policy options while providing collective support mechanisms. Japan's experience with high debt loads reflects unique circumstances, including domestic savings rates and demographic transitions that differ significantly from American conditions. What emerges from this analysis is recognition that American fiscal policy has entered uncharted territory where traditional assumptions about debt sustainability no longer apply. The mathematical progression toward crisis continues regardless of political preferences or economic theories about acceptable debt levels. The only questions remaining concern timing and the specific mechanisms through which fiscal reality will ultimately impose discipline on political preferences. Understanding these dynamics becomes crucial for anyone seeking to position themselves strategically for the fundamental shifts in American economic policy that mathematical realities will eventually force. The intersection of demographics, debt service costs, and political constraints creates a perfect storm that will reshape American governance and international economic relationships in ways that most observers have not yet recognized. Thanks for joining us for this analysis of America's fiscal trajectory. The mathematics of debt sustainability operate according to inexorable logic that transcends political rhetoric and economic wishful thinking. We'll continue monitoring these developments as they unfold and examining their implications for investors and institutions navigating this unprecedented fiscal landscape. Make sure to subscribe for continued coverage of the structural forces reshaping American economic reality.